Alright, this is a video that we're gonna continue our exercise, and now we're gonna go ahead and work on the adjustments. So before you make any adjustments, remember adjustments are made at the end of the accounting period. So the first thing that we're gonna do is we're going to tally up our accounts so we can go ahead and prepare first a trial balance. And what we're gonna do is we're gonna just balance out all the accounts to come up with these numbers. So here we first have cash. So in cash we're gonna do this number minus this number, and it shows 13,000, and it looks like it's gonna be on the debit side. So we'll take 13,780 on the debit side. On account receivable we're gonna do the same thing. We have 300 here, 200 here. It's pretty much 100. 100 on the debit side. Then in office supplies we have 120, so we keep it just 120 on the debit. On security deposit we have 2,000 on the debit side, so we just keep 2,000 on the debit side. Notice that in the bottom here is already totaling all these numbers. We have then prepaid rent, debit side 3,000, we put 3,000 on the debit side. Furniture, we have furniture 3,000, we put 3,000 on furniture. Accounts payable we have 200 on the credit side. So we're going to go ahead and put $200 on the credit side. Then we have notes payable. Notes payable we have 13,000 on the credit side, so we're going to put 13,000 on the credit side. Then we have drawings, and in drawings is right here in the bottom. We have $500 on the debit side. We're going to put $500. I do apologize. Capital first. Capital 10,000. Drawings 500. Childcare revenue. We have $600, so I'm going to put $600 on the credit side. Then we have a marketing expense, $600 on the credit side, on the debit side. Training expense, $300 on the debit side, and salaries expense, $400 on the debit side. This is a total of $23,800 and $23,800. These pretty much means that these accounts are in good shape. And the reason why they're in good shape is because the debit equals the credit, so that at least gives us the opportunity to see that we did not make any mistakes on the accounting right now. So we're going to put these two little bars in here saying that we've done all the work that we needed to do on this account. These are all the things that we have to work with on the trial balance. So we total everything up here, we brought it up here, and after we brought it up here, we pretty much make sure that this and this was in good shape. Next thing we're going to do is the adjustments, and for this example we only actually have two adjustments. First adjustment that we have is that for prepaid rent we have $3,000. That's including the month of July. So because it's including the month of July, we have to actually account for the rent expense that we had for that month. In order for us to be able to properly notate one of these 3 months past, which is January, we actually have to create an entry that says that we are crediting $1,000 from prepaid rent. That's going to create a negative side for assets. And we are going to debit rent expense, which is just to clarify that we are adjusting this entry to reflect January's rent. So keep in mind that these are journal entries like any other. So after this line here, we're going to put adjustments. So we know that we're talking about adjustments. 131, that we're going to debit an expense, rent expense. So we're going to debit rent expense for $1,000. Each rent is $1,000. We're going to credit prepaid rent. Remember, adjustments do not involve cash. They often involve another account, and it's usually a revenue or an expense, and another account that is not cash. So in this case, we're going to debit rent expense and credit prepay rent. These are adjusting entry to reflect January rent expense. We have to actually go ahead and do that also in our T account. So we're going to use that T account of rent expense, and we're going to put that they're actually a level of $1,000. Make this a little more here. And besides that, we also have to notate that there was a prepaid rent of $1,000 also on our ledger. We're going to go ahead and do prepaid rent. And this is going to be $131,000. So we have there, there was actually an account that was credited for 1,000. Once we do that, we also go back this first transaction. We're gonna add a letter to it, so or a number. So here we could just put A. So we know that this is the A transaction adjustment expense. So we keep track of when it happened, and then we can go ahead and go back to our worksheet, and we know that we create a rent expense. There's no rent expenses here, so we're gonna have to create here at the bottom rent expense, and that's gonna be a debit of 1,000, and the other one that's gonna be done is prepaid rent, a credit of 1,000, in case somebody needed to check your work and make sure that you did the proper steps. And then we have A here as well. So you know that one thing affected the other. This is what we have. The other transaction that we are going to change is the furniture. So we purchased furniture for IKEA for $3,000 on credit, and we said that this had to be paid in 60 months. In 5 years, which is 60 months. We tend to usually take care of this at the end of the year, but just for this example, we're gonna use it. So anything that you buy that has a lifetime of longer than 1 year, it's something like a furniture or equipment, usually does have some depreciation, meaning has actually a life of about 60 months. And if we want to point out that we used 1 month of the life of that furniture, you can actually do it by saying, well, it's $3,000 in expense. We could divide that by 60, and we could figure out that $50 is our per month accumulated depreciation. So this is called accumulated depreciation. We have to show that it's for furniture account, and this accumulated depreciation is actually something that is called contra asset. And a contra asset just means that it reacts differently than an asset. If you are contrary to an asset, and it's only used to reflect this is affecting in some way, shape, or form another account. So in this case, the account that is reflecting that it's affecting is the furniture account. And this furniture account, we're gonna have to actually show that the life of this furniture is lower. Now, accounting principles do not allow us to just decrease furniture. So in order for us to be able to show in accounting that we did that, what we actually have to do is we actually have to show in our adjustments that we are showing somewhere that this value, this is losing value, or this is depreciating every month. So we do that through first depreciation expense. And depreciation expense, what it does is it allows us to account for the fact that we used the furniture this month, and it has to be shown somewhere that there was an expense for that. Then we have to actually create another account called accumulated depreciation, and then we have to put in furniture. And this account again is a contra asset. What that means is that if assets usually are on the debit side, the contra asset will be on the credit side. So here we're going to go ahead and credit $50. And this shows that we had some use of that furniture, of that first $50 of the furniture. In order for us to show this in our ledger, we have to actually go ahead and create this accumulated depreciation account for furniture. And our accumulated depreciation, we can actually go ahead and say, well, on 1/31st, we credited $50, and the other account that is being affected by this accumulated depreciation is depreciation expense, which is being debited on 1/31 for $50. So far we took care of the adjustment expense, and we took care of the ledger accounts here, or the T or the T accounts that we have here. The next thing that we need to do is actually our general journal. And on the journal, we have to reflect that adjustment, because this adjustment is just like any other entry that happened. It's just that it's recorded at the end of the month. So in 1/31st again, we had a debit of rent expense, of depreciation expense for $50. And then we have accumulated depreciation furniture for $50. Say adjusting entry to reflect the depreciated furniture. That way, if somebody wants to come into the ledger and figure out what adjustments were made or what happened here, they can go to the adjustment line and see that these are the two that happened, and they're being reflected on the worksheet as well. So again, there have not been a lot of adjustments here, but we could go ahead and actually do this, which is we could sum up. So it's going to be 1,000 plus 50, 1,000 plus 50 gives us this, and then we're going to have here 1,000 here plus 50 here, and as long as they're equal, we are in good shape. I'm going to close it here with these two little bars that tells us that whatever work we had to do there is already done. So the next thing that we're going to do is actually just create an adjusted trial balance. So what we're trying to do is we're trying to bring up all this account to here, as they have been adjusted already. So in this case, we're going to do cash stays the same. All these accounts here stay the same because they're not affected by the adjustments that we make. Then we have here prepaid rent. Prepaid rent was at 3,000 and was credited 1,000. So if we actually take 3,000 minus 1,000 is 2,000 on the debit side. So we're going to do 2,000. Let me just brush up this thing here so it has the same colors. Then we have here furniture. Again, furniture was affected, but we have to leave furniture in peace because furniture has to stay with the same value, but we added a new account to reflect that accumulated depreciation on the expense. Accounts payable stay the same, notes payable stay the same, capital stay the same, drawers stay the same. Then we have rent expense 1,000. There was nothing here, so we just do 1,000 and just bring it over. 50, and then we do 50 here to bring it over as well. Again, there was nothing affecting it there. And this is the moment of truth. I'm gonna sum it up, and we're gonna just add all this here. It's 23,850, and we're gonna add everything here, and it's 23,852. So that means that we have a trial balance that is actually adjusted and is also equal. So we are in good shape. Again, when you use a trial balance, so everything is equal on the bottom, doesn't really mean that you are off the hook. What it does mean is that whatever adjustments you made were par with the things that you had here, and they transfer over correctly, and we have the same amount of debits and the same amount of credits being taken away. So just to sum it up, we had two adjustments that we had to actually put on the ledger. We had these two adjustments done on the ledger. We also had to use our T accounts to reflect those new balances. So 131 here, 131 here, and we also did it here, 131, did it here for the accumulated distribution as well. And we also reflected how the rent expense, the prepaid rent also gets down. So the next time around, what we're going to do is we're actually going to take the adjusted trial balance, and we're actually going to do what it is telling us. These are temporary accounts, and because they are temporary accounts, anything that has revenue or expenses on it or drawings, they need to be closed down because they're not part of that balance sheet that we saw in class number 2. They're part of the income statement, and some others are part of the statement of capital. So what we actually have to do is we actually have to close this account. So in the following video, I'm going to actually show you how to go ahead and do that.